Yeah,
please, please.
Make it more effective.
So now it is 6:05. I think you can start.
Yes, sir. So, Premnath Garu, you can have your opening remarks.
Right. Good evening, members. I welcome you all to this session on Code of Ethics at the. So I wish everyone a very happy CA day. We are very lucky to have JV sir, J. Venkateshwarlu sir. It's called as JV sir. We are very lucky. He has accepted it without any hesitation, with a short span of time.
Yeah.
And sir is also there on appellate in the ICAI on issues on DC proceedings and all. So we are very lucky to have this subject today on the CA day. I welcome you all to this. This is very important today. First of all, like every day we read newspapers, every day we do ritual puja like that. We need to have this code of ethics in our mind first. Before we carry out any activity, it is first we should think about code of ethics, and then Income Tax Act or GST or Companies Act or whatever it is comes next. First comes code of ethics, and then CA means code of ethics, and then comes the next one, any activity. So this itself will ensure the quality that people are expecting from the chartered accountants today. So sir will take us to the new code of ethics and old one, comparing it. And since sir was there in DC proceedings and in the institute while sir was in the as a CCM, so his very rich experience clubbed with the code of conduct and ethics will be of very importance for us, especially during this point of time when everything is in net. Thanks to Corona and COVID, it made everyone to come onto the net whether we like or not. Earlier we had an initial inhibition to move into the online system. Now everyone is enjoying doing this, and as a part of this, knowingly or unknowingly, we are leaving so much of evidence digitally on the digital footprints, which may be in our favor sometimes and which may be equally in our not in our favor also, because we are leaving so much of audit trail on the digital. Just for example, the general feeling is code of ethics is only for those chartered accountants who sign public listed companies. Sir will anyhow take us through wide range of experiences of the DC proceedings, where in very small cases like 150 rupees, taking 150 rupees and filing income tax returns, or also the clients have filed cases with the DC proceedings stating that the services of chartered accountants are not at the level it should be, stating that there was a professional negligence in terms of rendering, meaning we all know that they just take form 16, take 150 or whatever, sorry to say the fees, and then just upload the return. And now if I am doing it for 150, uploading an ITR by just taking form 16, now did I ask any questions to him? Did I ask his bank statement? Did I ask him, did I tell him that I am just taking your file and then uploading? Am I rendering uploading services? Am I rendering consulting services? Am I rendering tax planning advice? There is no return engagement between me and the client where I am charging 150 rupees. Now, if the client takes up an issue stating that he has not advised anything, he has not told me anything, then I may say, in the earlier circumstances, I may say that no, he is not my client at all. Then he may say, see this, the internet ID or the IP address is showing his office ID. Then I may simply say, no, without my acceptance, the student could have uploaded it. Because I was just taking cash and pocketing it, there is no evidence. But now, because I am not meeting client, he may send a Google Pay to my account. There is an evidence that I have done the job. There is an evidence that he has sent data to my email ID. And there is a lot of evidence that is getting created now, even for 150 rupees or 170, whatever it is. I'm leaving so much of trail through which I need to know whether it is 150 rupees or 1 lakh rupees fees. There is a risk of 1 lakh rupees of maybe the highest cases I think I have seen from the DC net now, which has been made open to public. You can see there where there are cases where more than 1 year there are suspended. There are cases of 1 lakh rupees penalty levied. So even if I charge 150 for a small return, I am facing the equal risk, meaning today's COVID situation has made everyone to be on the net, and being on net without knowing or unknowing, we are leaving so much of audit trail. We need to be very careful with this. This is one issue. Number two, we are collecting so much. Now we have to collect so much of evidence. Now everywhere we are conducting meetings on Zoom, including the client meetings are also carried out in Zoom, meaning there is a scope of getting recorded. This is again another challenge we are facing. Can we make these recordings as an evidence? Can the client make these recordings as an evidence and tell them I've already informed, I've already given sufficient information to the auditor, and auditor has not considered it. So in these circumstances, we are facing too much of, we are exposed to too much of litigations now. And at this point of time, I think JV sir's deliberations on the code will be of highest importance. And hence I keep saying every day morning we get up and pray. In the same way, we need to go through the code of conduct. We need to boil this. We need to dissolve this code of conduct and ethics into our blood. Before I say I am a chartered accountant, let me say I know the ethics, and then I have to say I know income tax, I know Companies Act, I know GST. So I say first I should know this. So this will properly guide me. This will make me to follow the documentation. This will make me to follow the auditing standards and accounting standards. Now I request Vijay Thodapalli sir to make few words and then leave the session open for the JV sir. Thank you. Thank you very much.
Thank you. Thank you, Premnath Garu. Thank you, JV Garu, for acceding to our request on a very short notice. This idea of code of ethics today we want to talk came around 10:30 in the morning. So immediately, we tried to look for speakers, and we felt Ms. JV Garu will be the best one because he has seen a lot of members and their cases, work very closely to the members. So we feel he's the best speaker we can identify on this CA day. So that's one. And before I hand it over to JV sir, I just want to tell you, members, we are planning to have a continuous series on code of ethics, probably not on every day, but we staggered it, once in a week or once in 2 weeks, to make members aware of and to spread this awareness, to lift the spirit of the members and to increase the quality of work which they do, and to improve their internal documentation in terms of demonstrating to the legislature and to the outside world that we are up to the mark. So we want to wipe out the negative features and the myth which the outsiders are thinking that CAs are manipulators. So that kind of instances we want to reduce and increase the image of chartered accountants. With this intention, we want to have a continuous series of code of ethics, because this code of ethics has been changed now. And unfortunately, members have not given very importance. That could be because they are not, they think their activities were not connected when it comes to their execution of work. Now with the processes that everything they are doing on a net, there are trails being there, so their work can be traced, monitored, and they can be grilled. So we need to be very careful and understanding what kind of ethical practices that we need to follow And I think, JV sir will take us through with some practical examples so that at the end of the day, we go back with a bit of understanding on what we need to do and what not to do. Thank you, everyone, and over to JV.
Very good evening, Premchand, Vijay, and all the members who have joined so far, and those who would be joining shortly. Am I audible?
Yes, you are. Yeah.
Okay. So very good evening, friends. And in fact, I should first say thanks to Premchand for inviting me on a CA day, which was to speak on this code of ethics, which has been just released. In fact, the volume 2 has been released just a few days back, maybe I think on 27th June or so, while volume 1 was released a little earlier, and volume 3 also was released a month back. So today, I think both Vijay and Premnath took lead and also coincided it with CA Day. So first, let me greet and wish all the members a very, very happy CA Day, because we have been bestowed by this degree CA, and we whatever today we are, I firmly believe that it is because of our degree and the status that we enjoy in the society. So let's rededicate ourselves for the cause of this profession, and to serve the government and public at large to the best of our ability, so that we can keep the image of the profession high and hand over to the successive generations with a big image of the profession and the institute. I also wish that all the members are comfortable in these COVID times. In the last 2.5 months or so, all of us are mostly confined to homes, and excepting on emergencies, we are not able to go out. And even now, I'm sure many of the members are staying at home because the situation is still not under control. In fact, the number of cases are going up. So therefore, my sincere request and advice to the members are to stay back at home and take care of yourselves. With this little brief, I would like to start off the topic, because the topic is very huge, and the organizers have suggested that we should close it in an hour and a half. So I'll start off with this code of ethics and a brief on the disciplinary mechanism. Before starting, I would like to say that the slides which you are going to see have been prepared by the Ethical Standards Board of our institute when the code was getting introduced, and in the council and other places. So they have mainly compared the 2009 code and 2019 code, because the last revised code is in place in 2009. And 2019 is the first volume that came out. So therefore they have compared. So you will find most of the slides, a comparison between 2009 code and 2019 code, and the newly brought out do's and don'ts, which you will find place in this new code. Therefore, please bear with me that I may not be taking through all the code in full text, but I'll be taking you through major changes brought in by the 2019 code. But wherever required, we'll spend a little time on understanding the issue, both either the newly brought in amendment or the old this thing. And at the end of the session, I'll also speak on a few practical case laws which I have, which I have come across and I remember for the occasion, so that you can, understand what kind of cases are generally filed and how the disciplinary mechanism is working. So essentially, the code of ethics is a set of rules, professional and ethical principles and standards regulating the relationship of CAs with clients, employers, employees, fellow members of the group, all the, in general, at public at large who are using our services or who are dependent on our signatures and certifications. It is essential for commanding the respect and confidence of the regulators and public at large. And conduct of members, basically you're all aware that it is regulated under the Chartered Accountants Act and the regulations made thereunder. So you are all aware that we have this code of ethics written way back in 1963, the first edition, which contained mainly the do's and don'ts and explanation and commentary on Schedule 1 and Schedule 2 to the CA Act, which are called Code of Ethics in that edition. And since then, the institute has been amending that, and it was issued as a council guideline. So it's mandatory for all the members. Since then, it underwent 12 editions so far. The 12th edition has come just a few days, as I was telling, and the 12th edition has been revised thoroughly in line with the IESBA code. IESBA code. As I was telling, just a brief comparison of Code of Ethics 2009 had a part A and B, which was valid up to yesterday. And part A was based on International Ethical Standards Board of Accountants Code, which was there in 2005 edition, IESBA code. That was adopted in 2009 code, suitably incorporating the changes as applicable to our laws, domestic laws, and Indian laws and our chartered accountants rules. And part B was based on domestic provisions and governing members. Then the Code of Ethics 2009 has been divided into 3 volumes. The volume 1 again is based on the IESBA Code of Ethics of 2018, because IESBA revised its code in 2018, and so which was brought in as a volume 1 in our Code of Ethics, which is effective from today. And Code of Ethics Volume 2, that is basically domestic laws, particularly the Companies Act requirements and the Chartered Accountants Act requirements, as applicable to the chartered accountants, that is contained in volume 2. And the volume 3 consists of all the disciplinary case laws, so far decided disciplinary case laws, segregated under various sections and clauses. So that is how the structuring has been done. And the adoption and implementation, this is the revised 12th edition. First time the code is segregated into different volumes. The time duration will give the members opportunity to be aware of the things. And E-code also is being prepared, and it will be made available very soon. And the institute has started advising all the branches and POUs to arrange meetings for updating this on the Code of Ethics. Then we come on to the volume 1. The major important changes which have been brought into this volume 1 are vis-a-vis 2009 code. The first and major change is responding to non-compliance of laws and regulations, which is a very important change. This is the NOCLAR. It is in simple words, it is called. We will deal more with it in the subsequent slides, but briefly to tell you about that, the chartered accountant is expected to deal with a situation where if the assessee or client is not complying with any of the applicable laws and regulations, there is a duty cast on us to report such non-compliances to the appropriate authorities. So this is an additional new law that has been brought into this Code of Ethics. So which is for the time being made applicable to only listed entities. So any auditor of a listed entity, if his client is not adhering to the applicable laws and regulations, he is expected to report on this. We will deal with it in a little elaborately in the subsequent slides. Then restrictions on taxation services to audit clients. Now you are all aware that under 144 of the Companies Act, there are several restrictions on the services that we can render to a client to whom we are doing the statutory audit. So therefore, there the restriction on taxation services is also included, though it is coming in the Companies Act, but in the code also they have brought it here. So however, here tax audit can be done, but not other representation and other consultancy services cannot be added. And then there is a prohibition on management responsibilities to the audit clients. That is, we are not expected to assume the role of a management and carry on the responsibilities to the audit client where we are doing the statutory audit. Of course, we can do certain administration services to the managements, but we cannot assume the responsibility of the management and become a kind of a management position. We cannot occupy the management position. One more new rule is that whenever you get a fee of 15% or more from a single client, for a period of consecutively for 2 years, you are duty bound to inform that exceeding of 15% fees to the that particular client in a as soon as you complete the 2 years. This also we will deal little more in the subsequent slides, because this is also brought in for the first time, mainly to keep the independence of the auditors who are doing with. This is also applicable only for the companies which are big companies, and where the fee is, suppose if the fee gross fee of the auditor is not more than 5 lakhs, then it is not applicable. And so the clients which are having more than 15%, paying more than 15%, again exclude the banks, public financial institutions, public sector undertakings, all those things. But this is definitely going to play some impact on some of the firms where they are serving more to particular clients because of their size, etc. So this again, one may note that the duty is only to inform the particular client, not to report to anybody else. But then we need to address it also appropriately to bring it down to less than 15%. Then the last important amendment is the duty of accountant in case of unintentional breach of independent standards. Because in volume 1, you will find that certain independent standards have been brought in while we are doing the audit. Suppose if any of these independent standards are getting breached, and if we are not able to address these things, then there is a duty cast on the accountant, either to first to address those breaches, second bring them down to the acceptable level, and the third level is that you strip the remove the audit, say goodbye to the audit if you can't do the first two things. That is, the first one is either delete the, remove the breaches. Second one is bring them at least to the acceptable levels. The third one is then skip the audit, give a go by to the audit. Few other important changes that have been brought in is independence requirements for audit and review engagements and other assurance engagements have been differentiated. You will see it in part 4A and 4B of this volume 1. Independent sections were recharacterized as international independent standards, because we have borrowed all these independent standards from the International Code of Ethics. We have made them international. The use of word should has been replaced with shall, making it more mandatory wherever such words are used. And the new pattern structuring of sections requirements have been distinguished from application guidance. And there is an increased clarity on responsibility for compliance firms, network firms, individuals within firms, etc. Because each have been given the separate responsibilities have been identified. What are the network firms, individuals, etc. within the firms. The word professional accountant has been used extensively in IESBA code, because even in 2009 edition also it was there. So now in 2019 code, we have also used the same professional accountant, but it has been defined also as a member individual who is a member of our Institute of Chartered Accountants of India. Then the IESBA code uses the term professional accountants in business, implying members who are employees. That is, we call them as members in industry or members in service. So we have called them as members in professional accountants in service, in line with our usage in the CA Act. Then this is 2009 code structuring. Part A used to deal with the general application of the code, then professional accountants in public practice, accountants in service. Then part B used to based on domestic Indian provisions, accounting and auditing standards, Chartered Accountants Act, council guidelines, self-regulatory measures, and appendices. Almost in the same lines, the current 2019 code also has been brought in, but it has been divided into 3 volumes. So this is the structure of the volume 1, where in the revised 2019 code, the first part deals with the complying with the code, fundamental principles and conceptual framework, where you will find the fundamental principles that a chartered accountant or a member should have, possess, and the conceptual framework within which we need to work, like the threads and other things we need are dealt in this part 1. Then part 2 is professional accountants in business, business in the sense service. And part 3 deals with professional accountants in public practice. All these 3 parts, requirements shall be complied with the members. The part 1 is for everybody, part 2 is for members in service, and part 3 is for members in public practice, and part 4 is a new concept which has been brought in, international independent standards. That is, these are the requirements of an independent chartered accountant while doing the audit. Part 4A deals with independence for audits and reviews, and 4B deals with other assurance engagements. In fact, you will come across certain changes in these things that even the code deals exhaustively with acceptance of gifts, fee structuring, relationship with the clients. All those things are dealt in this part 4A and 4B for those who are engaged in these assignments. Yeah, this was, as I said, 2009 also was issued as a guideline of the council, and 2019 also is issued with the changes of should to shall. So which means the code is as good as mandatory for all of us, right from the smallest member and the youngest member to the senior most member. And any deviation or non-compliance with this will amount to non-compliance with the clause 1 of part 2 of second schedule, which reads as a member of the institute, whether in practice or not, shall be deemed to be guilty of professional misconduct if he contravenes any of the provisions of the CA Act or the regulations made thereunder, any guidelines issued by the council. So this code of ethics being a guideline issued by the council, it is mandatory for all of us, and please understand that it is applicable to everybody, not necessarily only for the big auditors or big firms. And then new pattern of structuring, as we have already explained, they have given introduction for every section. They have put it is made it as a sections. Introduction first part, and then requirements designated by the letter R, and application material designated by the letter A. So each section has been dealt very clearly in a detailed manner. So this is the first thing, responding to non-compliance with laws and regulations. Section 260 and 360, new provision enacted in this new code of ethics, which refers to any act of omission or commission committed by a client or employer contrary to prevailing laws or regulations. In such a situation, the member is expected to report it to the appropriate authority. Appropriate authority could be either ROC or to SEBI or RBI or income tax or whatever it is, under which act or which subject he is dealing with. So this has been introduced mainly to bring out the ethical responsibility of our members, not to turn a blind eye to the matter. And this was introduced to help and guide the professional accountant in dealing with the situations and deciding how best to serve the public interest in these circumstances. So this is effective from today, the new provision, which is there on the statute book. So whenever you are doing the audit and you are supposed to bring out any non-compliances with the major law to the appropriate authority. So the applicability of this new rule is only for the time being started with only listed entities, while IASBA code says it is applicable to all assignments and employees in the code. But in India, we have made it applicable only to the listed entities and only to the audit assignments. Again, it will not apply to other assignments like consultancy or other assurance things. And in case of PAs in service, also applicable to employees of listed entities. That is, if the members are in service with the listed entities, even there also they have to bring out such non-compliances to the notice of appropriate authority. Otherwise, he will also be deemed to be guilty of misconduct. Again, the scope of these laws and regulations, Institute has given a guidance on this. The laws and regulations that have a direct effect on the determination of material amounts and disclosures in the financial statements. That is, here also we are using the word materiality and direct effect on the determination of material amounts and disclosures, and other laws and regulations compliance with which may be fundamental to the entity's business and operations or to avoid material penalties. Like, for example, if a pharmacy company is there, if they are not following the drug controller's rules and regulations, that will have a fundamental non-compliance. So we need to report apart from other Companies Act and other things. So examples of laws and regulations required to be addressed are fraud, corruption, and bribery, money laundering, all these terrorist financing, etc. So in a nutshell, we can understand that wherever the non-compliance is material and important and fundamental to the entity's business, we need to report to the appropriate authority. However, the small things like matters which are clearly inconsequential and personal misconduct unrelated to the business activities of the client or employer, or non-compliance other than by the client or employer, or those charged with the governance and other individuals working for under. If any of these conditions are satisfied, you need not report. That is, matters which are completely inconsequential, as small deviations or a personal misconduct. Suppose if the managing director is involved in some unethical personal life, then we need not report that. And by non-compliance other than by the client or employer. Suppose if it is a big company, then those charged with the governance and management working also are covered. If someone else at a lower level is involved in this non-compliance, then one need not report on that. And the professional accountant is required to address NOCLAR only when and if he encounters the same in the course of providing a professional service. That is, when you are doing the audit service, if you are coming across these non-compliances, you need to report it. But suppose after completing the audit and after going out, if you come across any such things, then you are not under any responsibility to report that. That there maybe somebody else will take care of it, or maybe in the next year when you go back, you may have to report it. And the appropriate authority for the purpose of disclosure will depend on the nature of the matter. For example, appropriate authority may be SEBI in the case of fraudulent financial reporting, or ROC, or other authorities as may be relevant for the subject. That is the authority to which we need to report. Then these are the independence standards which have been defined in, elaborately dealt in volume 1. That is, part 4A deals with independence for audit and review of engagements, and part 4B deals with independence for assurance engagements. In fact, these standards, they are more or less same for in both the cases. But just for your information, they are not in the slides. I can just take you through a few points. Yeah, the part 4A deals with independence for audit and review engagements, which talks of application of conceptual framework to independence for audit and review engagements. You need to, there are certain guidelines while fixing the fees, compensation and evaluation policies, gifts and hospitality, when to take, when not to take, actual and threatened litigations, if any, loans and guarantees, then business relationships, family and personal relationships with a client, serving as a director of a client. For example, if you are the director of a client, then there are certain, and immediately after directorship, you cannot accept the audit for 2 years. So like that, employment with a client, temporary personal assignments, auditor rotation, all these things have been listed under part 4A with a suitable guidance to the members, that whenever you have, are not fitting into those criteria, we should take adequate care to address them firstly. And if not able to address them, at least bring them to an acceptable level, or the last resort is leave the job. So this is the dealing with the same thing, breaches of the code, mechanism of self-correction prescribed in the code in case the PA on his own discovers an unintentional violation. Suppose if you come across unintentional violations, we need to address those violations as soon as possible and rectify it. And then what are the mentioned various steps to be taken in the case of breach of independent standards? That is, whenever you identify that a certain breaches of the independent standards, then end, suspend or eliminate the interest that created the breach, consider applicable legal or regulatory requirements and apply them. Suppose if you can't deal with those things, then you need to consider the legal and regulatory requirements also to apply to the situation. That is, you are all aware that whenever there is a problem, you find certain developments after issuing audit report, you have one of the standard deals with withdrawing of our report. So in all such cases, we need to consider what are the applicable regulatory requirements and take appropriate action. Then the key audit partner, a new term has been brought in under the 2019 code, which is nothing but, in a nutshell, we can say that the one who is signing, who is taking all key decisions or judgments in the matter, and so finally signing the audit report. This is the new word with a definition brought in. So we need to understand who is the key audit partner, because in big firms you will find more than one person, but in a smaller firms you may not find more than one partner doing it. So this is the definition: the engagement partner, individual responsible for the engagement quality control review and other audit partners, if any, on the engagement team who make key decisions or judgments on significant matters with respect to the audit of the financial statements. So he is named as a key audit partner who will be responsible for the signing of the statements. The Again, 2009 Code of Ethics contains requirements relating to rotation of partners and audit staff, but that is there in 2019 Code also, with some more additional changes. So earlier, even under the old Companies Act, we had no the rotation of partners or firms. But now the 2013 Act has brought in certain changes in the retirement of rotation for certain category of companies. So this has been more aligned, and in fact the code is more stricter than the old code. That is, in the 2009 code, while 7 years time was there for all the staff who were engaged in a assignment, where the 2009 code says all the people who are working on a particular assignment on of a listed company, or now it's called public interest entity, they have to retire and take a cooling off. There is no change in that requirement in the 19 code also. And in the earlier code, it was a 2 years cooling off for other members after that 7 years change. But in the revised code, they have kept 5 years cooling off for the engagement partner. I mean, the partner who has done 7 years audit of a company cannot come back to that assignment for another 5 years. That is what the code prescribes. And the engagement quality control reviewer cannot come back for 3 years for the same assignment. And for other all key audit partners, 2 years cooling off. So these cooling off periods are not in line with the Companies Act, but these are exclusively made by the Code of Ethics. So members have to note that when your firm may be continuing beyond 7 years, because a firm can continue for 2 terms of 5 years. But if you have conducted the audit for 7 years, you have to take a clear cooling of 5 years. You are not supposed to engage in that particular assignment. And EQCR cannot come back for 3 years after the 7 years, and other key audit partners 2 years. This is what partner rotations. As you are all aware, 2013 Act brought in this firm rotations, but partner rotation is the shareholders' prerogative to prescribe partners rotation. So also you may be aware that RBI and IRDA have their own restrictions and rules on the rotation of partners. So, and the firms, all of them have been brought into the code on par with the other applicable regulations. This is what during the cooling off period, the partners or engagement partners cannot come back to the same, even by giving a technical or industry specific issues, and leading or coordinating the professional services provided by the firm, and even other activities also which would influence the team. He should not get in, because that's what having significant or frequent interaction with the senior management or those charged with the governance should not be done, or exerting direct influence on the outcome of the audit engagement. He should not get into such kind of activities. The partners who are in cooling period should stay away literally from the assignment or with the team. This is the new concept, management responsibilities, as we were talking in the beginning. The firm or the partner should not assume the management responsibility for an audit client. That's there is a very thin line of difference between what is a management responsibility and what is an administrative services. That's what the code has defined. What are the services permitted for various for the CAs to an audit client, which are essentially administrative services, which have been dealt elaborately in the code. For just for example, one of the last service that is permitted is administrative services, which includes like they have given some examples: the word processing services, preparing administrative or statutory forms for the client approval, submitting such forms as instructed by the client, monitoring statutory filing dates, etc. These are all administrative services which have been defined and which can be rendered by us, but not the management services which have been management responsibility. But the other management services which are not falling under the management services, you can render. They have been given an exhaustive list in the ethical, the code of ethics, pages 11 to 14, which are, I can just take you for a highlights of these things. Yeah, they are basically clerical services which are not management because I'm not able to trace out immediately. So these are services which are listed here. These are the kind of services which you can attend to a client, but you should not assume a management responsibility position. That's what the code makes it very clear. The non-assurance services, as we have seen in Companies Act, there are almost all other services other than audit have been prohibited to be undertaken by a CA to the same client. In fact, of late, some of the big firms are giving a declaration that they will not accept any other service, particularly after ILFS fiasco. Many of the big firms are declaring that they will not take up any of the audit services, some of them including tax audit also. But audit, you can do tax audit, but not the other services which are in the nature of a management services. These are the new prohibitions on recruiting services also have been covered. And we are not supposed to engage into any of these services with the client to whom you are the statutory auditor. The taxation services, 2009 also, there was a that included compliance planning provision, all those things were there. But in the 2019 code, further guidance on taxation matters provided. Generally, it states that providing tax services to an audit client might create a self-review or advocacy threat. So that is the reason why we are supposed to not to get into the providing any tax planning or advisory services. The tax calculations, for example, for the purpose of preparing accounting entries, which will be subsequently audited by the same firm, creates a self-review threat. Therefore, you should not get into such services. Tax planning or other advisory services also might create a self-review or advocacy threat unless you take appropriate safeguards. That is like using professionals who are not audit team members. That is, if you are also have to do some tax planning or other advisory services, do not allow the same partner who is doing the audit to render that services. Allow other partners or other reviewers to do that. Tax services involving valuations, you can perform only where the result of the valuation will not have a direct effect on the financial statements. Suppose if it is going to have a direct effect on the financial statements, definitely we cannot undertake the valuation. And assistance in the resolution of tax disputes, that is appeals, for example, might create a self-review or advocacy threat, because unless you take appropriate safeguards that to not to provide if it involves acting as advocate for the audit client, or amounts involved are material to the financial statements on which the firm will express an opinion. That is, if the tax liability is a very material amount and you are aware of what is the outcome of an appeal or what is likely to be an outcome of an appeal, it may become a self-review or advocacy threat. Therefore, you are advised not to undertake such kind of assignments. The safeguards what the members have to take have been defined in the 2009 code also. And in the revised 2009 code, the application of safeguards required to eliminate threats or to reduce them to an acceptable level. That is, we need to reduce the risk to an acceptable level. What is an acceptable level again has been defined as a level as the reasonable and informed third party knowing the facts would likely to conclude that the accountant complied with the fundamental principles. That is, it's like an arm length transactions. Suppose a third person who is an unknown party is reading it and understanding the things and understands that the accountant has performed the fundamental principles. So that is the acceptable level. So you need to take care of these threats, bring them to an acceptable level. The new introductions, again, the threats have been addressed in the following three ways. Eliminate the circumstances creating the threats and apply the safeguards, or decline and end the service. So these are the three situations how we have to deal with the threats. The first one is elimination, second one is apply the safeguards, or the end decline or end the service. And a new step back requirement has been provided herewith, where the accountant, on an overall conclusion about whether the actions that the accountant takes or intends to take created will eliminate those threats or reduce them to an acceptable level. If the threats cannot be addressed, then you should decline or end the engagement. These are the expectations of the members as brought out in the new code. Again, the close and immediate family have been redefined under the new code. In 2019 code, for companies, relative of a partner refers to the definition as given in the Section 77 of the Companies Act. It is aligned with the Companies Act definition. And for clients other than companies, the immediate family or close family as appearing in IESPA code has been brought in. That is, a close family means a parent, child, or sibling who is not an immediate family member. And an immediate family means a spouse or dependent. That is the only two people have been listed in the immediate family, and a close family, a parent, child, or sibling also have been brought in. Then the new concept has been brought in the 2019 code, which is called public interest entity. Essentially, public interest entity is nothing but a listed entity or an entity which has been created by central government or other state governments through acts, and banks, insurance companies, etc. Essentially, this is nothing but all the companies covered, like earlier, public PSUs, listed entities, and in private sector, all listed entities will come. And in public sector, all public sector entities will come. So certain links have been given for this public interest entity. Therefore, it is important to note what is a public interest entity when you are getting into the audit of a client. As I was telling, inducements, including gifts and hospitality, have been elaborately dealt with. That is, in the 2019 code, if you look on the right sides, inducements have been elaborated to first see whether prohibited by law or regulation, offerings also prohibited, reasonable and informed third-party test, clarifications about appropriate boundaries for offering and acceptance of inducements. So that's in a nutshell, the professional accountants are not expected to accept any inducements or gifts, and they should be more careful while taking or accepting these inducements and gifts. The documentation part, 2009 also, there is a clear requirement that on compliance with independent requirements, but 19 code has elaborated the requirement of documentation in greater detail, which are listed in the 5 bullet points. That is, the auditor is expected to first create the information on the facts of the case, accounting principles or other relevant standards involved, the communications and parties with whom matters were discussed, courses of action considered, and how the accountant attempted to address the matters. All these, in these 5 areas, one needs to keep adequate documentation. Even for the NOCLAR also, all these 5 areas have to be kept sufficiently documented. Then only you can justify your reporting to the appropriate authority. So that's how the members are expected to keep adequate documentation on all these areas. And then the fees, again, we spoke about in the beginning. The requirement is 15% of the total fee received by the firm in 2 consecutive years from a single client. It should be disclosed to those charged with the governance of that particular client. It is not to be reported to anybody else, either to the regulatory bodies or to the institute or anybody, but you need to report back to the client who is paying you more than 15% of your gross fees. But this is not applicable for smaller firms whose gross receipts are less than 5 lakhs. And again, no such ceiling on the total fees of a firm would be applicable in the case of audit of government companies, public undertakings like nationalized banks or other public financial institutions, etc., which are whose appointments are made by the central government. There used to be one more restriction under the old code, that 40% fee from a single client in self-regulatory measures in the 2009 code has been deleted with. Now you can accept any amount of fee from a single client, even more than 40% also. But if it is crossing 15%, you need to get back to that particular client and inform him that you are getting more than 15% of your gross income from that particular client. What the code has described is that you need to take adequate safeguards not to lose your independence in all such situations. The code doesn't say that you need to quit the assignments, but you need to take adequate safeguards to not to lose your independence in all such cases. Then there is a criteria of indebtedness on the concept of materiality, etc. In 2009 code, there was no concept of materiality, but in this 2018 code of IESBA, they have brought in a concept of in determining whether such a loan or guarantee is material to an individual, the combined net worth of the individual and the individual's immediate family members may be taken into account. Here also we have adopted the same thing, that is, if I have borrowed some amount from a company under the Companies Act, there are restrictions, clear restrictions, not to borrow from the same client or from in excess of some 1,000 rupees or 10,000 something. I don't exactly remember, but the code has brought in some more stricter norms that while evaluating your net worth, you should also include your immediate family members' net worth. On the professional appointment, the 2019 code has brought some more changes. You are all aware that in 2017, our institute has issued a guidelines on know your clients. I don't know how many of us are following, but definitely there is a requirement of know your guidelines. This is nothing but like our know your guidelines, KYC norms in the banks, that we are expected to know what is the name and address of the client, PAN number, TAN number, SIN number, and then nature of business and key people in the company. All those things we need to maintain a record of these things. And so these are all mandatory, in fact, for all attest functions from 1/1/2017. And in case of change of appointment, if unable to communicate with the predecessor accountant, the proposed accountant shall take other reasonable steps to obtain information about any possible threats. That is, if you are not able to communicate with the previous auditor, maybe because of death or because of non-availability of that particular previous auditor, whenever you are accepting a new assignment in place of another auditor, and if that previous auditor is not available, you are expected to take other reasonable steps to obtain information about any possible threats. The code has given some leads in this angle. That is, if you can't reach out to the old auditor, you need to look at other alternatives so that you will be able to safeguard yourself from any possible threats. The communication requirements in the case of audit and non-audit assignments have been slightly differentiated. And there is a new duty is cast on the predecessor accountant, that is the previous accountant, to respond to the communication. That is, whenever you are accepting a new assignment, you are expected to write to the previous auditor. And the earlier code, the previous auditor was not under obligation to respond to you. But under the new code, the previous auditor has to respond. There is a duty cast on him, and he shall comply with the relevant laws governing the request and provide any information honestly and unambiguously. Suppose if he is leaving the assignment due to some problem with the client or some frauds, etc., he is expected to tell you honestly. If he doesn't tell you honestly and later on it is found that he deliberately did not tell you, then he can be held guilty of professional misconduct. That's how the previous auditor also has been brought under some responsibility in this aspect. This is again a contingent fee based on contingencies should not be accepted. But the exemptions for this is insolvency professional or liquidators earlier called. They were allowed to charge fee based on the collections or other, the insolvency on the collections and distribution, etc. Otherwise, we are not expected to. We are prohibited rather from charging any fee based on contingency. Applicability of provisions for members in service to members in practice. This is nothing but if you are working with a CA firm, though you are not in practice, but all those provisions also would be applicable to the members who are in service with a CA firm. And the preparation and presentation of information. Again, the more comprehensive provisions addressing public accountants in service responsibilities when preparing or presenting information. That is, even the members who are in industry are expected to prepare and present the information honestly and correctly. And prohibition on exercising discretion when preparing. Again, one should not present any information which is misleading or inappropriately influencing the contractual or regulatory outcomes. And enhanced guidance to assist public accountants in disassociating from leading information. That is, if you are finding your client doing something wrong, then there is a guidance on how to disassociate at the earliest from such client or from furnishing such misleading information. The code gives you some leads in that direction. Then volume 2 is more concerned with the members in many of these areas which deals with the code, our schedule 1 and 2, and other areas which are directly applicable to us, like advertisement guidelines and other things are dealt in volume 2. These are the most important changes. Is, as you are all aware, many of the laws which have a direct impact on us, like Companies Act 2013, then our own Chartered Accountants Act guidelines, regulations, all these things have undergone many changes in the last 10 years from 2009 to 19. And including some clauses, some commentary has been appropriately dealt with on clauses 6 and 7 of first schedule part 1. Also on the clause 8 of first schedule relating to communication. All these changes have been captured in the new code. These are again mode of presentation in the volume. This is MCS, that is Management Consultancy Services, Administrative Services. That is, while we can create a management consultancy company also, a private limited company with the permission of the institute. We can be in a full-time practice as well as be a managing director or a full-time director of a company with the permission of the institute where management services are rendered. But while being a chartered accountant, you cannot assume management responsibility, which we have earlier discussed, but you can definitely render management services, administrative services, but not management responsibilities. These services include the 2009 code, which was available, which included insurance financial advisory services, including insurance brokerage, that has been done away with. Now we can only do including insurance brokerage, but not including insurance agency. You cannot accept any insurance agency, but you can always render any service in relation to insurance financial advisory services. Again, the valuation services, earlier 2009 code, you can value the shares and business and advise regarding amalgamation, merger and acquisition. The 19 code says that valuation of shares and business and advice regarding amalgamation, merger and acquisition. Acting as a registered valuer under the Companies Act 2013, you need to deal with, you should be a registered valuer under the Companies Act to do that service. Again, qualification, mentioning the qualifications, there is a famous case which you are all aware, ICAI versus ICAI, which was delivered in 2007, where Supreme Court said that therefore there cannot, therefore any doubt whatsoever that the other qualification would mean a qualification other than granted by an institute of accountancy, subject of course to recognition thereof by the institute. That is, you can have a qualification on your visiting card, only when the other institute is approved by the institute or a recognized university, etc. These are the visiting cards. There are certain prohibitions. Members being directors in any company, because many of us are also on the boards of some of the independent companies, where you cannot write that directorship of that company on your professional card, or even a politician cannot use the designation of MP or MLA in his professional card. In the same way, it is insolvency professional and registered valuer are permitted, because both of them have been recognized by the institute. If you are an insolvency professional and registered valuer, you can use them along with your professional card. Even for the regional and central council members, they cannot use the such positions on their professional visiting cards, but institute giving now to these members institute visiting cards. Then the retirement of partners, there was an elaborate section in the 2009 code that has been completely repealed. So now any issue between the partners have to be settled on their own through legal means. If it has to go to a court of law, it is a civil dispute. Generally, institute will not interfere in the disputes between partners. In the 2009 code, there was a elaborate requirement that has been done away with now. So members cannot look at the institute for any of their internal disputes. The commentary under clauses 3 and 4 of part 1 of first schedule, that is the referral fee amongst members. The old code is silent. The new code is it is permitted under the commentary to clause 3 of part 1. What the clause 3 of part 1 says that accepts or agrees to accept any part of the profits of the professional work of a person who is not a member of the institute. So this is prohibited, but in case of an MDP, that is multidisciplinary firms, it is allowed. So, but multidisciplinary firms are not in place, though the law has been amended enabling to set up such multidisciplinary firms. Other institutes have not come forwarded, and the necessary regulations have not been framed. So therefore, we don't have these MDPs in real life so far. And then no equivalent of director simpliciter in partnerships. In a company, you can be a director simpliciter, but in a LLP, that is limited liability partnership, you cannot be a partner. That's what the code says, that in case if you are a director in a company as a simpliciter, which means that you can only attend the board meetings without becoming any whole-time employment or like a whole-time director, you are allowed. But in an LLP, you can't be even a normal partner like in any other partnership businesses. So that members should take care. And even in a routine partnership firms, also any business partnership firms, you should not be joining as a partner without the prior permission of the institute. The guidance on tenders. Again, this is a big subject. Regularly, members keep calling. And there are some restrictions on members responding to tenders. As of now, most of us are responding to the tenders. Particularly, tenders are called by the government departments or government PSUs only. And the institute has given a guidance in 2016, as per the circular mentioned here. Institute said that a member in practice shall not respond to any tender issued by an organization or user of professional services in areas of services which are exclusively reserved for CAs, such as audit and attestation services. That is, if the attestation is reserved, I mean, if the function is exclusively reserved for chartered accountants, we are not supposed to respond. But however, such restrictions shall not be applicable where minimum fee of the assignment is prescribed in the tender document. Suppose if the tenderer himself prescribes a minimum fee that has to be, the one should not quote below that, then institute permits you to respond to that, or where the areas are open to other professionals along with the chartered accountants. Suppose if it is an internal audit or some other forensic audit where any others are also allowed, then you can respond to them. And there are FAQs on tenders issued by the institute. And we have also said in the FAQs that if there is an exorbitant EMD, in fact, if I remember rightly, sometime in 2013 or so, one of the PSU has called for tenders for this conversion work or some internal audit work, where they said that 28 lakhs has to be paid as a EMD for along with the tender schedule. So in all such cases, one needs to be careful, and there are FAQs issued by the institute. Please look at this. And I also wish to advise the members that whenever you are submitting a tender with a price, you are expected to keep justification and adequate documentation for working out the fee with you. That is, if someone complains that in my own case, when I was the director of a public sector financial institution, somebody quoted for 12,000 rupees annual fees, whose gross income was around 3,000 crores or 4,000 crores. And when we rejected him, the next time he quoted with 1 rupee. So finally, we have dealt with him differently. But whenever you are quoting for a tender, you are expected to maintain the documentation. Suppose if somebody complains that you have quoted a very abnormally low fee to the institute, then you are expected to submit your details for all those things. So therefore, adequate care has to be taken how you are quoting such a abnormally low fees for any assignments. This is again a CPA, the name, these things. That is, you are allowed to use the other degrees of other institutes like CPA only where the institute has a membership reciprocal arrangement or MOU with ICAI is permitted. Otherwise, if you have any other membership of other institute which has no MRA or MOU with ICAI, then you are not expected to use those memberships on your visiting cards. Then sponsoring activities, the member or a firm can sponsor an event, but however, ICAI events, that is permitted with the approval of CPE Directorate. In relating to other charitable donations or sponsorships that if a member wants to sponsor, they can use the name of their individual only with the prefix EA, but firm name should not be used. So be careful while giving any sponsorships for sports or other activities to use only your name with the prefix of CA and not your firm name in a big way with any logo. The advertisement of teaching coaching activities, again, this is all an advertisement of coaching activities is incorporated, but it should not lead to any violation of our regulations. And the new educational videos also can be uploaded. No reference should be made to the CA firm wherein he may be a partner or a proprietor. The TB credits also, some more detailed information has been given in the code. And authorship of books, definitely you are welcome to write any books and publish, but use of prefix of CA or name of firm only, name of firm is permitted. Professional attainments prohibited. However, use of prefix of CA or name of firm permitted. That is, you can write the firm in which you are a partner, but not any other professional attainments. Advertisement of silver jubilee or golden jubilee celebrations, looking at the social status of the firms and to give some mileage, the golden, diamond, and silver jubilee of any CA firms may be published in the newspapers. The illumination of signboard, again, keeping in mind the appropriate visibility and illumination of the signboard is slightly relaxed. So one needs to be careful to keep the board not in a very elaborate or like a business partners. Then internet added to TV, films, and commentary to class 7. The firm name may also be mentioned. However, whenever a member is speaking on a TV or interviews, he can mention about his firm name, but not in any manner which gives which shows an exaggeration or claim or any kind of a comparison with other firms should not be permitted. He should not get into that comparison, etc. And network and logo, again logo, you are there is a already prohibition on use of any logo by any CA firm. Only CA 2 letters can be used, and CA logo guidelines also are there, which has been given as an appendix to the our this volume 2. And modes of communication, this is an important topic which every one of us comes across. Whenever you are accepting a new assignment from an audit which was done by earlier another chartered accountant, we are expected to communicate with the previous auditor. And earlier, the mode of communication was restricted to registered acknowledgement queue. That is continued to be there now, or by hand against written acknowledgement. And the newly added, two more things have been added, which are acknowledgement of the communication from the retiring auditors via email address registered with the institute or the last known official email address. Suppose if you get an acknowledgement from the previous auditor saying that, acknowledging your email from his official email ID, which is registered with the institute, that is also sufficient compliance with this clause 8 of the first schedule. Or the last new added thing is, after the UDIN portal came into picture, through UDIN also you can accept the communication. So this is a very, very important communication, and all members are expected to communicate for all kinds of audits or attest functions. It includes statutory audit, internal audit, concurrent audit, even bank branch statutory audits, and any other audit functions. In fact, there are many cases where even concurrent audits nowadays are allotted by the banks through the empanelment of the members. And even in such situations also, some of the members have complained to the institute that the new incoming auditor did not communicate to them. And in a particular case, the institute, following this rule, have held them that new auditor is guilty of professional misconduct under this clause. So my humble request to all of you is, whenever you are accepting a new assignment which was done by earlier under by another CA, please communicate to him with a reasonable time. And the communication is the most important, and you need to keep evidence of sending such communication, preferably either communication through RPAD or by personal delivery. And if even if the other auditor is not responding to you, doesn't matter, you need not worry, but you need to give him a reasonable time. You can't give it on 29th September and sign the audit report on 30th again. So please take care to inform the previous auditor with a reasonable time. Duty on the previous auditor, we have dealt in the earlier slides that revised in the code, there is a duty on the outgoing auditor or a previous auditor to inform the correct information to the incoming auditor, so that he will take appropriate action. Suppose knowingly, if he doesn't inform the incoming auditor that there is a fraud or there is some kind of a non-compliances in the client office, then the outgoing auditor may also be held guilty of professional misconduct. So we need to be careful while responding to the new auditor's request. And the addressing the peculiar circumstances while communicating, these are the communication. Suppose what happens if the premises is locked, the cover is returned with office found locked. So if such kind of a note, it comes back with the acknowledgement, then it is sufficient compliance that you have discharged your obligation of writing to him. Also, in the new code, they have dealt with one more situation where firm not found at the given registered address. The earlier code was silent, but if the acknowledgement comes back with the remark of no such office exists at this address, then that is sufficient compliance. You keep that acknowledgement and the letter, whatever you have sent. But if the retiring auditor proves that it was not really served and the acknowledgement is bogus or something not correct, then again it will not be treated as a deemed service. The communication in case of certification, certificate of posting has been dispensed with. Now there is no such posting is allowed. Then clause 9 of part 1 of first schedule, which deals with the compliance with the erstwhile section 225 of the 1956 Companies Act or 140 of the current act. Of course, this clause is applicable only for the companies which are appointing auditor other than the one who is retiring auditor. So whenever you are accepting a new appointment in place of someone, either by his resignation or by rotation or etc., you need to ensure that the requirements of 140 of the current Companies Act are duly complied with, and you should always take some evidences of the compliance by the company also. Generally, we go by the company's confirmation and of the requirements, but it is always safe that you keep a copy of all the special notice and the reply of the outgoing auditor. All those things you need to keep a record of whatever you have taken the evidence. And then this is a director simpliciter. It was earlier used to be ordinary simple director. Now it has been modified as a director simpliciter, which has been defined as a person who is not a managing director or a whole-time director and is required only in the board meetings of the company and not paid any remuneration except for such attending meetings. That is, you can join in any company as a director simpliciter, but without intimating the institute also, provided you don't have any substantial interest, you or your family members in such company, and you are not the auditor of that company. And also, it's though it is not a requirement to inform such directorships, but my suggestion is always inform the company, even if you are appointed by the government of India. It's always better to inform the institute so that they will be aware that you have joined the so-and-so company as a director, simpliciter, or as an independent director. If you don't inform and subsequently if some problem comes, then we will be held responsible for non-compliance with our own code and established rules. The HUF vis-a-vis member in practice, generally if you inherit any HUF business through inheritance or succession, then you need to inform the institute and take their permission. And there also, if you are going to be actively involved in that HUF business as a karta, then institute will give the approval, but they will say that you are entitled to be only a part-time practitioner. So in which case you cannot sign any balance sheets. Therefore, you need to be very careful in handling the family business, particularly when it is coming through inheritance or succession. You cannot be a partner in a family business, or you cannot be a karta of a HUF where your active time is devoted to that business. And first of all, without informing the institute, you should not get into that. But one small leeway that is given is while dealing with such HUF businesses or family businesses, and if you are allowed by the institute, the funds of that HUF can be invested in as may be prescribed by the council if it makes the investments. That is a normal thing only. Then commentary on confidentiality. This is only more on a proprietor or partner who has to respond to these things. And then amendment in commentary under clause 4 of part 1 of second schedule. That is the substantial interest, where whenever you have a substantial interest in a company or a business, you are not supposed to engage that client as your client. So this has been made in line with the Companies Act, where the 20% is the voting rights or the share capital. If you hold, you will be deemed to be having a substantial interest in that company. And in such situations, you should not get in as a professional with that particular company or entity. And there is one new requirement, that cooling off period after completion of tenure as a director. That is, if you are a director of a company, either as a simpliciter or as an independent director, you cannot be the auditor of such company for a period of 2 years from the date of completion of your tenure as a director. That is, you resign or retire from that company on 1st April 2020 till 1st April 22, you cannot accept the audit of that company. This is not there in the Companies Act. This is a new rule brought in this revised code. The generally accepted audit procedures, of course, you are all aware that peer review is a requirement now by the institute for all members, and in case of listed companies, SEBI requires the firm to possess a peer review, and mandatory printing of quoting firm number and membership number wherever you are signing, and UDIN from 1st July 2019 for all non-corporate and corporate audits, attest and assurance functions. This includes concurrent audits, internal audits, tax audits, all kinds of audits have to be now given this UDIN number. So please take care to take the UDIN number for all audit and attest functions. The advertisement guidelines, they have brought in all the advertisement guidelines earlier, so-called website guidelines, telephone directories, online consultancy, specialized directories, advertisement through press releases. All these things have been brought under at a separate as a separate section in the code, which have been dealt with in our these clauses of part 1 and part 2 of schedule 1 and schedule 2 also. All of them have been brought under at a single place. The write-up again about our firm, etc. There are some small cosmic changes. They have changed some of the words. That is, we should not write too much about our positions held as a director or a managing director, etc. And then addressing peculiar circumstances while communicating. Again, while writing about your firm, It should not be too long narrating all your experiences, etc. It should be brief and should not be of a nature that might bring the profession into disrepute. That is, your write-up of your firm or yourself should not bring in any disrepute to the profession. These are all guidelines on how to write and what to not to write in the write-up about our firm or ourselves. Then the advertisement guidelines, again, they have elaborated more, because now we are in a very electronic era where social media, so many things are coming out. So this is all more stringent and more restrictive way. The changes in council general guidelines, these are all again small changes which we are generally adhering. Tax audit limits that are there, it used to be 30 to 45, 45 to 60. All these consequential amendments have been done. And ceiling of fees, again, there are some self-regulatory measures where in the code earlier, as we said, the 40% restriction was there, that has been done away with. And this 15% fees from a single client consecutively for 2 years is now required to be reported to the, though charged with the governance, with the exemption of that 5 lakhs pounds or other public sector fees, etc. And these are the various appendices to the code. They have enclosed almost all relevant guidelines and all these things. And these are the changes in the revised code, mission statement. They have mentioned purpose. All these things are in line with the International Ethical Standards Board code. And this unjustified removal of auditors. Originally, this committee used to be called as SESURA, Committee on Unjustified Removal of Auditors. That is there, but very rarely we come across any complaints or petitions under this, because nowadays people are approaching the company law authorities like ROC or NCLT whenever they are removed in an unjustified manner. So this is more of an academic purpose only. And the volume 3 deals with all the case laws decided from 1949 to till date. I have not gone through whether all the case laws were covered or not, but at least important case laws have been covered. This volume deals with only case laws under various clauses held by the disciplinary committee or council earlier. They have been, I think, with a search mode also, they have brought it out. So this will be very useful for the members to look at case laws, decided case laws for any reference to deal with the current case laws. And these are the general, overall observations and significant changes that have been brought in the new Code of Ethics, which is made effective from today. So the volume 1 deals with all the rules and regulations that a chartered accountant, how to be more independent and not to get into the pressures from the client. And volume 2 deals with the various applicable laws, domestic laws under the Companies Act, under the Chartered Accountants Act and Code of Ethics. And the Schedule 2 also deals with all the schedules, the volume 2 deals with both the schedules of the Chartered Accountant Acts, for the Chartered Accountant Act. Schedule 1 deals generally with all the procedural things and how to be in general with the relationship of the member with various public and others in the society. And Schedule 2 deals with more stringent with the professional work that we are doing. So those two parts also, schedules also have been covered in the part volume 2. And volume 3 deals with exclusively case laws. So volume 3 is nothing applicability on applicability side, but definitely volume 1 and 2 are as good as schedule 1 and 2. They are mandatory for all of us, and we need to go by those rules. For example, Companies Act deals with only companies, whereas code, this ethical code will apply for non-corporates also. And some of the retiring partners, etc., the code has more stricter norms than the Companies Act. So all these things makes the code very important. And my humble submission to all the members are, however seniors we are, once in a way we need to turn the pages of these codes to see that we are not deviating or violating any of these things. And coming to the disciplinary mechanism and the first and second schedules, which talks of code of do's and don'ts for the members. It's a very important in our professional career, because these both the schedules define what to do and what not to do for our members. Schedule 1 talks of more with reference to our relationship and our appointments, etc. And Schedule 2 deals with more of a professional subject and how to respond and how to carry out the subjects or audits while we are on the jobs. And absolutely, both the schedules covers almost all areas. Not a single area is left uncovered in these two schedules. And both the schedules are there right from 1949. And unfortunately, many of our members, we are not well versed with these schedules and what the requirements of these schedules for our members. And the misconduct also has been defined in section 22, which talks of broadly, the definition is like this: a professional or other misconduct deemed to include any act or omission provided in any of the schedules, but nothing in this section shall be construed to limit or abridge in any of the power conferred on the director discipline to inquire into the conduct of any member of the ICAI under any other circumstances. Which means it is not only these two schedules, but the director discipline or the disciplinary committee can inquire into any other situation or any other circumstances where a misconduct has been defined. So the professional misconduct is covered in both the schedules, which is first schedule has in all 4 parts. The part 1 deals with professional misconduct in relation to CAs in practice. Part 2 deals with professional misconduct in relation to members of the institute in service. And part 3 deals with professional misconduct in relation to members of the institute generally. And part 4 deals with other misconduct in relation to members of the institute generally. That is, part 3 and 4 deals with general misconduct, and 1 and 2 deals with for members in practice and members in service. Second schedule has 3 parts. One is part 1, professional misconduct in relation to CAs in practice. There are 10 clauses in this. Part 2 deals with professional misconduct in relation to members of the institute generally, and part 3 deals with other misconduct. While all the the part schedule 1 has 19 clauses, second schedule has 15 clauses. Class wise, if we have to go through, it takes a lot of time. But the commonly observed mistakes, and the complaint which are leading to become a complaints and cases and finally awarding of punishments are in a few sections only. I'll just take you through this. I'll just take you through these clauses in a brief way, so that we can.
Sir, my submission is,
Yeah.
you can give examples. Probably members will be excited,
Right.
rather than going through the clause in which they can read it
that's
anyway.
what. I'm not going into the clause wise. I'll give you some cases which have been decided.
Yes, sir.
So that it will be interesting to the members.
Yes.
For example, the one recent case that I have come across is a chartered accountant has signed the partnership deed of one of his client. Who used to generally come to him for signatures and other filing of the forms. This he was signed in somewhere in 2003 or 4, not knowing that one of the partner mentioned in the said deed is no more. In fact, the firm was owned by a family, 2 brothers or 3 brothers, and a father was there. And somewhere during the period, father passed away, but one brother who used to regularly come took lead and brought in a partnership deed containing the expired father's name also. So this gentleman, our member, unknowingly, without causing a deep inquiry, on the belief that the client is giving the correct details, he witnessed the form. And later on, it was found that the father who was mentioned in that deed was no more about, he died about years back. Then the brothers got into fight, and this man was pulled into the institute apart from going to the registrar of firms. And the registrar of firms did not find the chartered accountant as the responsible for the whole problem. They nullified the action and the format, the changes to the partnership form. But then the institute complaint came heavily on him, saying that you are signing without causing any due diligence of whatsoever. So the institute held him guilty, and the case is waiting for the punishment. So this is one case where generally we trust the client and sign without actually verifying or collecting any evidence of their existence or otherwise. So in another case, a member has attested the Form 32, that is now, I do not know, DIN Director DIR 2 or 3, where we inform the changes to the ROC for new directors joining or leaving of the old directors. So he attested his digital signature, and wherein he was found to be not correct in certifying those things. So he was held to be guilty, and his case is coming up for punishment soon. So like this, one should be careful. And another area where many of the members are getting caught is signing these capital structure and the capital expenditure certificates for projects which are under implementation. See, generally we sign the capital structure or capital introduction certificates certifying the X amount of capital has been brought in. Earlier, it used to be share application used to be kept for a long time, but after the 2013 act came into force, thanks that we need to close that share application money. In one live case, the chartered accountant who was not auditor of that company was called by his CFO friend, and he was asked to certify the capital introduced during that particular period up to say September 30th or so. He has issued a certificate, and luckily he has taken the ledger extracts of the share application money. And after the year end, the banker found that this amount stated in the certificate was much less than the amount what is appearing in the, higher than the what is appearing in the balance sheet. That is, as on 31st March balance sheet, audited balance sheet, while the share application money was shown as 50 lakhs, the chartered accountant who has issued a certificate in the middle of the year was showing around 1 crore or 1.5 crore. So the banker filed a complaint, and the member was pulled into the institute, where the member has sufficiently demonstrated that as on the date of his issuing the certificate, he has taken an appointment letter, he has taken an engagement letter, he collected the evidence of the ledger in support of the figure, whatever he has issued. So with all those things, he could come out. And on the other hand, he has also challenged the banker how he has released the loan based on a share application money certification. So that's a different issue. Banker got very much annoyed by the auditor questioning him. But the fact is that unless we take in several other cases where we have noticed there were fraudulent withdrawals from the banks. In fact, whatever I am quoting, they are all happened in Andhra Pradesh and Telangana, nothing from outside. So many of our members have got into unnecessary troubles, particularly the cases where the CBI and others involved, where the client was in collusion with the banker, duped the cases. The chartered accountants were unnecessarily booked and without much evidence. For example, in one case where the share application money was brought in, everything in cash. Of course, not in the recent years, but a few years back, about some crores of rupees was introduced in the cash. So the banker has relied on the CA certificate, and CA relied on the books. And finally, after 2 years or so, when the unit did not go through, the case was booked against the CA, also making him a party. So the whole problem is coming because we are not able to keep the documentation required. Client also will not give us sufficient time to keep the documentation. Many of the times they send their accountant or someone to get the certificate immediately for loan withdrawal, etc. But many of the cases were found to be fraudulent cases, and the members were held guilty in all those cases for their lack of negligence. And another area is concurrent audits of particularly bank branches. In many cases, we have seen where there is a concurrent audit, there are frauds, and the members are not able to report those frauds because many a times for the small amount of fee given by these banks, our members are not able to go and they send some juniors or even sometimes the articled or paid assistants and not able to cover the things, and sometime later the bank will be found to have erred or colluded in a fraud, and then the case will come and it will first ban to be booked by the bank management is the chartered accountants. And in a case where a particular senior member was booked, the facts of the case are like this. He received the appointment letter sometime in May and did the audit of first 3 months at one go in sometime in June. And though he was not given access to the new loans sanctioned during that period, he simply mentioned in that letter that it is nil. Actually, there were new loans given in that period, but unfortunately, our member did not give them with description of how much amount was given. So, on that reason, he was held guilty for giving incorrect and misleading information. Then another area is where we receive sometimes the money of our clients for payment of his own taxes and other expenses on his behalf. There is a clear clause 11 of part 1 of second schedule where we are expected to keep the client's money in a separate bank account. In a live case in Bombay, we have come across a very peculiar case where a chartered accountant compiled the information for preparation of the return of a retired government servant, and he calculated the tax and informed the client. It's about more than 10 years back case, maybe 15 years. So there was a capital gains amount, and the chartered accountant calculated the tax and asked the client to send the amount to his account. Either I don't know whether he has asked or the client has sent for his convenience sake. The chartered accountant, what he did, he has not paid the entire amount to the department on the same date. He held it back in his own books of account for some time. He shifted that amount from one account to another account and withdrew some cash and did all kinds of things with that amount. And finally, after some time, paid a part of that amount and issued the challan. On seeing the challan, the client found some suspicion on the genuineness of that challan. So he's a retired man with a lot of interest and suspicion also on the challan. What he noticed, he went to the bank carrying that challan and found that that was not the original challan. The original challan was something less than what he received and was holding it on his hand. So which means the challan was forged and the auditor was subsequently caught red-handed, and he agreed and he paid the balance tax also to the government with the interest under 234A, B or whatever it is. And the client did not leave the CA there. He filed a case before the institute. And the institute, on perusal of all the evidences produced by the client as well as our respondent member, we found him absolutely guilty and unbecoming of a CA, in other words. In fact, during the disciplinary committee, I was also a party where we held him guilty, and we have given him severe punishment also. So another area is very important section is due diligence and gross negligence in our professional assignments. This is reflected in clause 7 of part 1 of second schedule, where a member will be held guilty if he is grossly negligent or does not exercise due diligence or is grossly negligent in the conduct of his professional duties. This is what the clause 7 of second schedule talks. This is though very simply worded, it covers all areas of our due diligence and financial statements. And there are other sections also, right from clause 5 to clause 8, which talks of failing to disclose material information, failing to obtain sufficient information, and all those things are there. Most of these financial statements, wherever the regulators and others are filing, they cover these clauses, and many of the times our members are not able to keep adequate documentation. Particularly, we are very weak at keeping the documentation. That is what many of the times we find. Thanks for the 2013 Act, where we are filing the appointment letters. Prior to that, not even appointment letters were there. Engagement letters are not there. Audit documentation in terms of SA 230, many of them are not able to show the documentation. Particularly in the fraud cases, our members are not able to produce any of the proper documentation justifying how they have taken a decision in the particular issues. And of course, non-compliance with accounting standards, non-compliance with Schedule 3, non-compliance with Schedule 3, Part 1, Division 1, Division 2. All these things are coming out, and all of you are aware that we have a FRRB in the Institute, one committee, Financial Review Reporting Board, which picks up about 100 cases every year of a big entities, and they will do a cool review. And wherever mistakes are noticed or non-compliances are noticed, they don't even call the chartered accountant seeking any information. They will simply go by the, it's called full review. Then they go only by the balance sheet and see whether all the requirements of disclosure norms, measurement norms, and all the accounting standards have been complied with or not. If any of them are found to be major non-compliances, then disciplinary, they will refer it to the disciplinary committee, and disciplinary committee will initiate action. If there are any minor deficiencies, they would send an advisory to the concerned auditor. The other area of complaints frequently coming is from the regulators, SEBI, RBI, Income Tax Department, and even other ministries. We have come across several other ministries where subsidy certificates and other things are not correct, issued by our members. Therefore, they have also lodged complaints. Income Tax Department has lodged many complaints. In the earlier days, when there were a few chartered accountants who were involved into frauds and forgery of TDS certificates, and they claimed huge refunds, and subsequently they were not even seen in India because we have passed orders ex parte. They left out of India, and so many cases are there. Whenever a government files a case, then they look at us with the least respect and the least importance. For example, in another case, one chartered accountant was involved in filing 3 types of balance sheets for a some kind of a trader. One for the income tax department, where he followed AS 9 regularly, and another for sales tax department under erstwhile sales tax audit, where he created some stops in not recognizing. He used a word called stock transfers or something, and did not recognize sales. And so there he helped the client to postpone or evade the sales tax. And the third thing is the real balance sheet. This is a real case. I am not trying to exaggerate. And it has happened in Andhra Pradesh. And the tax department did a raid, and then the client and also the chartered accountant were taken into custody for some time during the trial. And later on, the case filed, and I don't know subsequently what happened. But there are many areas, and I can also say that the complaints need not be from the person who is affected with your financials or who is affected with your services. It can be anybody. Even a passerby finding mistakes in your balance sheet can file a complaint or can pass it on as an information to the institute, and then the institute will take it up. So therefore, one needs to be very careful while handling the cases. In fact, I have come across a case recently where the district cooperative banks of normally all the in every district there is a cooperative banks where they give huge gold loans, and the gold loans, the appraiser will be there, manager will be there. They are supposed to have done their job, and it was found that several spurious gold were kept, and the manager, appraiser were hand in glove, and the concurrent audit is there. Concurrent auditor used to go there, and normally they don't even get into the gold verification, etc., on a regular basis. So finally, a fraud was detected where all the concurrent auditors were issued notices. In another case, income tax assessment of an individual, was taken up by a chartered accountant who has collected the power of attorney and filed before the ITO, attended to the hearings, assessment order was passed, and some demand was raised, etc. And later on, the assessee says, I have not given him the power to appear before the IT. I don't accept the IT assessment order. The chartered accountant has done fraudulently, and he filed a case before the institute. So because he never had any engagement letter, etc., because normally none of us take an engagement letter for appearing before the IT officers. So that is how our members are getting wrongly caught on several issues. And there are like that, there are many cases coming up under various sections, and including the famous big cases where we found non-compliances with the auditing standards. For example, confirmation of balances with the third parties. The firm has not done that confirmation exercise at all. So while reviewing the case, we found that the chartered accountant firm did not comply with the most important auditing standards. They have given a go away for these kind of important standards. So we found them that they are grossly negligent in conducting their professional duties. So coming back to the mode of complaints, etc., the complaints are two kinds. One is information, other one is a formal complaint. The formal complaint can be filed by anybody. It need not be a chartered accountant. And with the fees, there is a form I in the rules prescribed form I. It's a simple form. They have to give the reasons, etc. The other mode is information. The information again is a wide term that any information which is worthwhile accusing a member of suspected gross negligence or suspected misconduct can be taken up by the institute or by anybody who can pass it on. So in the case of a complaint, formal complaint, there will be a complainant. In the case of information, there will be no complainant. Institute will assume the role of a prosecutor. So, and then the first level is the director discipline. The director discipline will forward the complaint to the respondent and seek his written statement, and he will give the written statement. That written statement will be again sent to the complainant for his rejoinder thereon. And after receiving the rejoinder, the director discipline will form a prima facie opinion, what is called a prima facie opinion, considering the complaint, the written statement of the respondent, and the rejoinder of the complainant. All the three documents will be considered, and if there are any other material information or decided case laws, etc., based on the facts, he will form a prima facie opinion. That prima facie opinion will be placed before the board of discipline or before a disciplinary committee, depending on the offense which is covered in Schedule 1 or Schedule 2. If it is of a Schedule 1 or if it is of a Schedule 1 which is closed, then it comes before the BOD. If it is of a Schedule 1 and 2, or if it is a referral case, then it will come before the disciplinary committee. And the disciplinary committee may or may not agree with the view of the prima facie opinion. That is, if the prima facie opinion says there is no case and it has to be closed, the DC or BOD may not agree with that. They may go ahead with reversing that and say that this case needs to be examined. And once if the DC or BOD takes a matter that it has to be further examined, then they will, both the parties will be issued notices of hearing, and a procedure of hearing will be held. And maybe it may take more than one hearing, or sometimes more than 5-6 hearings also. And all, like any other civil court procedure, production of witnesses, etc., also will be there. And after hearing both the parties, considering the witnesses and other evidences, the BOD or DC will decide the case and pass an order. And that order again is challengeable before the appropriate appellate authority, passed and created under our own act. Because earlier it was a high court, but now the disciplinary committee's order with the punishment awarding both will lie as an appeal before the appellate authority. Appellate authority again will give an opportunity to both the parties concerned. But here one thing one has to note, that if the complainant is a CA in the primary complaint and the matter has been closed by the DC saying that there is no case, the complainant cannot come for appeal before the appellate authority. Only the respondent can come. Whether it's a CA complainant or any other complainant, any other complainant cannot come before the appellate authority. Only the respondent agreed with the decision of the Board of Discipline or a disciplinary committee can come for the appeal. Then after the appellate authority, one can go to the High Court and thereafter Supreme Court. And in case of complainant wish to pursue the case, not accepting the case of the disciplinary committee or board of discipline, he has to go to the by way of a special leave to the High Court. So broadly, and the punishments are three categories. That is, one is reprimand. That is the most minimum punishment. And the second one is removal of name. Removal of name may be starting from 1 day to life. One can be removed. And the third thing is monetary penalty also. The monetary penalty in the case of Schedule 1 offences should not exceed 1 lakh. And in the case of Schedule 2 offence, it cannot exceed 5 lakhs. That is the maximum penalty leviable under our Act. And in the case of Schedule 1 offences, the name of the firm cannot be removed for beyond 6 months. In the case of second schedule offences, it can be removed for life. For such period, the first schedule offences up to a period of 3 months only. Under first schedule, for first schedule offences, the name removal can be for a period of 3 months and the penalty up to 1 lakh. Second schedule offences, the maximum penalty leviable is name removal for lifetime and 5 lakhs penalty, or both simultaneously also. That is the maximum penalty leviable under our Act. And of course, these are again appealable. And but one very disturbing situation is that the cases are being increased from year to year. And right now we have more than 2,000 cases at various levels, right at the Director of Discipline, BOD, or awards for punishment, all those things. And cases are coming from all quarters of the society, not only the members and the previous communication, and from regulators, from income tax, other regulators, SEBI, RBI, MCA, so many quarters complaints are coming. The one important thing is communication with the previous auditor. As I was telling you, communication with the previous auditor is another area where at least 30-40% of the cases used to be under this clause alone. The two elements important thing is the new auditor has to accept write to the previous auditor in a reasonable time, seeking his objection, if any, for accepting his appointment. If the retiring auditor or the outgoing auditor is not responding, no problem. But if he is responding and objecting, then you need to address that objection. Suppose if he is raising some silly issues, then you need not worry. You can address them and record your reasons for accepting the assignment despite his objection. One more thing one has to seek his no objection is for any disputed fee payable to the outgoing auditor. If there is any disputed fee payable to the outgoing auditor, then that has to be paid before before accepting the assignment. If he is not ensuring that this undisputed fee is, undisputed audit fees, it is not to include other consultancy fee, only audit fees is to be paid. So that is one area where member has to be careful, and this communication has to go by way of either RPAD or a personal acknowledgement delivery, or in the two other new modes that to send it to his email ID registered with the institute or UDIN portal. So it's a very, very important, and also one should not just communicate for the sake of communicating on the last day or the last day. In fact, we have come across a case of some 2013 or so, where a tax auditor has accepted a new assignment done by the earlier auditor. And he claims that he has sent it by a registered post. But the registered post slip is not looking genuine, because it is now before the appellate authority where we were looking into that. So when we asked them to bring some confirmation from the postal authorities, he went and came with empty hands saying that the postal authorities regretted to say that we cannot furnish because it is so much of long back data we don't have. So we do not know whether the complainant says it is bogus, he has not received. The respondent says he has the evidence. So now the evidence is not backed by any reliable evidence. So therefore, we were thinking on what to do. Like this, there used to be so many cases on this clause 8 alone, which at least members have to address on that. Where the most of the times we miss it is in the case of charitable institutions, trusts, societies. Many members are either not aware or they might have taken it easy. But it's very careful that one has to be very careful to communicate with the previous auditors, even in the case of statutory branch auditors allotted by the respective bank through a very transparent mode. Still, one has to communicate with the previous auditor. In the given small time of a few weeks, many members may say, how do we communicate with the previous auditor? But that is one thing which we need to look and at least send by email and keep yourself away from the possible things. And in the case of concurrent audits, definitely we need to write to them in our own interest. Sometimes there may be some frauds in the bank, and where we need to understand and how to, protect ourselves. So in all such cases, it is very important for us to communicate with the previous auditor, obtain his acknowledgement, at least if not this thing. Now the law has been amended and the code of ethics casts a responsibility on the previous auditor to state the information honestly. In fact, in one of the cases known to me, the outgoing auditor quietly quit the assignment, suspecting or knowing that there was a big fraud in that. The incoming auditor, not knowing that, has accepted the audit, and then after some time, it was found to be that it's a big fraud, and unfortunately, both of them were caught. That is a different issue. But had the outgoing firm has alerted the new incoming auditor, he wouldn't have probably accepted that kind of assignment. So like this, there are a number of cases which are coming, and there are some cases where the partners also had disputes. In a Maharashtra state, we have come across a case which is about a very old firm where one partner, as soon as he joined, he started creating troubles to other partners. He went on litigating the affairs of the firm, and then he stopped the release of funds from the bank accounts. So it traveled almost for 12 years in the institute for coming for a final shift. They went around all around the cases. And another area is again this sharing the information of the client with other regulators or under law. That is another important information where one needs to be very careful that if you are summoned or required by a regulator or by a law enforcing agency to give some information about a particular client against whom a case is registered or they are inquiring, we need to be careful in giving such information. Sometimes if you give without taking any care, the client may come heavily on you and say that you are guilty of misconduct by giving the confidential information to the regulators or whoever it is. So therefore, you have to create either take a legal opinion on you are giving or not giving, and or at least the law should stand with you that you should give that such kind of information.
Sir, one point I want to make on this submission, what you said, in terms of the giving information to the regulator, what it was being suggested is to put this clause in the engagement letter of each assignment, saying that you are going to share the information to the regulator if they ask us directly. See, otherwise what happens is the regulator may come heavily on us if you don't share the information.
No, if you can keep that in engagement clause, there is nothing like it. You are fully protected. No, I am talking of situation.
All the
I am talking of a situation. For example, income tax investigation department is inquiring into a case. See, you are their tax representative or consultant. And if you are asked privately certain confidential information of the client, and if you disclose it unknowingly, then you will be caught by the client. So when every time you officially, definitely you have to take protection. In case if your engagement letter is silent, then you create a document or take a legal opinion on you are giving the information. So these are all the areas. I mean, in the given time, we are already 2 hours little plus. So if any member has any questions, etc., I can answer. Otherwise, you can.
Few minutes. We take just 5 minutes, sir. I think
Yeah.
I've requested Premnath Garu to sum up any questions. I think most of the questions were raised by Ravindran only. Probably,
Ravindran knows me, and I will answer his queries. I think he's not there in the audience also now.
No, he is there. He is there.
Okay.
But in case we have short of time, we will take it privately. What I'm requesting is everyone to share their email IDs, so that if the time doesn't permit, then we can email them with your answers separately, so that they can have it leisurely and read things.
Agreed.
And Premnath Garu, can you sum up at least few questions, 5 minutes, so that we can conclude? That will be better. It's already to us.
Yes. Yeah. Thank you very much for your excellent presentation and summing up. It's very, very important at this point of time, where the image is at stake. So you have clearly made everyone to feel the responsibility on the CA day, especially on the CA day. Most important is, as you said, this code is coming effective from this date. This date, incidentally. I am very much worried now. Say, sir, I don't know how to take this. Today, I am signing one listed company now. Now, there is some non-compliance. Now, for the year March 2020, now should I have a responsibility to intimate to the said regulators as on this date if I am signing?
No, in terms of this code, definitely not required. But if you feel that it is a non-compliance and where it's better to inform, you can inform. I mean, it becomes earlier application of the code. Strictly under the old code of ethics, there is no requirement for you to, under the code of ethics. I'm not talking under the CARO, where there is a requirement if you come across any fraud, etc. Under Companies Act also, there is a big requirement to inform the government, etc. But under the code of ethics, because the NOCLAR provision is coming from today, under NOCLAR provision, you need not. But if it is a material issue where you wish to inform, you are at liberty to inform. But take care of the client also, whether he will be there next year or not. Also, you look at
that is subject to, that is already there, sir.
Right.
But my responsibility today is, say, as you said rightly, the regulators are behind us. Now, the first question they'll ask is, as per the code of conduct, you should have informed, you have not informed.
Right.
Now the case is already there, and basic documents itself is highlighting all these things. And say, for example, I am representing a case of a GST ITC claim I am representing, where the subsequently the GST authorities have proved that's a fraudulent ITC.
Right.
Now they'll ask that, having known this, you have argued with the department, you know very well, you have collected the documents, and in all the circumstances, is it better for me now itself to go ahead and do it, or that is the biggest challenge from today onwards?
Again, NOCLAR, they have given some exceptions like inconsequential or small items or fraud committed at some lower level, etc., etc. So you need to take a judgment based on the facts and circumstances of the case. But definitely NOCLAR is not there till yesterday. If you are signing the balance sheet with any date prior to yesterday, including yesterday, you will not be found guilty under non-compliance for NOCLAR. But if it is generally under Companies Act, if it is coming as a fraud and you are expected to report, you take care of that requirement. Under Code of Ethics, definitely you will not be expected to deal with that situation.
One issue, sir. The another more dangerous issue is non-practicing chartered accountants or the chartered accountants who are working in the corporates now.
Yes.
There are, if anyone reads FRRB, there are a lot of accounting standards non-compliances.
Yes.
Very glaring one. Now here, there are many chartered accountants in, say, a big size of 2,500 crores of companies, there are at least 5 or 6 chartered accountants working there. Now, whether all the 5 will be, they have to report it, or only the CFO, or how this will be taken, sir?
No, I think it's a very valid question. But though in a company there will be 5, 6, or 10 companies, big companies like ITC, etc., there will be several people working at different levels. The person who is handling or who is coming to know of such non-compliance will be expected to initiate the matter and take it through the proper forum, because a lower level person cannot go and complain. In the office order also, there will be certain levels. So he has to take it to the next level like that. Suppose if the higher ups are not agreeing to him, maybe he is expected to report. If he doesn't report, then the problem will be on him also. At the appropriate authority, if they decide that the issue has percolated from the down and the down fellows did not report, I can quote a disciplinary case where the lower level managers, etc., who found the fraud and misreporting, reported to his higher ups. The higher ups made them shut their mouth. And when the final this thing came, the lower level people proved that they did not, they have reported, but the higher ups did not heard them or taken their view seriously. So in such cases, the lower people were given some relief. So therefore, instead of saying that who is responsible, the person who is coming to know or whose jurisdiction the non-compliance is identified will definitely have some primary responsibility. It is not the CFO alone who is, if he is a member of the institute, he is expected to talk to him, report.
When to inform, sir? This is another issue. When should I inform?
It is again, it is a judgmental matter. You need to inform at the appropriate time. I'll say appropriate time means maybe suppose during the course of a finalization or something, or during the year also. Suppose some fraudulent purchases or sales or a practice is going on, which is non-compliance with a particular law. Then as and when he comes to note it, and then after verifying the facts and after documentation is very, very important. He cannot just say that there is a big fraud going on in my company. He has to establish, he has to identify the facts, he has to look at the compliance with other laws, and then note it on what circumstances he found it, and he has to report it. Again, there are no prescribed timelines, but for a practicing member, they said that during the course of his audit, if he comes to know of it, he has to report it, but not after the date of signing of the accounts, etc.
Whether this is applicable to internal audits and also external, yes, understood. But how about
only listed audits, only listed companies, statutory audits, not for internal audits.
But here again, for the work, listed companies means those chartered accountants who are working from the employment point of view.
It's applicable to them also.
Again applicable.
Yes, yes.
Again, most challenging now is proprietary firms who are doing listed company audits. They have a very big challenge of partner rotation now.
Partner rotation, not only partner rotation, even EQCR, he will not have another partner. There will be only a single partner. That is why I don't think there is anyone who is a proprietary concern doing the audit of a listed company.
There are, sir. There are people. Majority are there.
No, but there is under SQC1. SQC1 permits you to give that limited assignment of EQCR, etc., to an outsider also. But it will be very difficult for him to comply with the various auditing standards. First of all, we have different standards dealing with various situations. A proprietor cannot demonstrate that he has followed the different levels of checks and quality control.
While I fully agree with you,
yeah,
the proprietor may be reluctant to give that assignment or employee somebody else as a quality review partner, because he will be scared to lose that particular client. Okay, no matter if he has a strong relationship with that client, and if it is a family business, and for the sake of listing, he has listed it. That is a different matter. So he will have. He may be reluctant to
No,
invite
if
an
he is,
outsider.
no, I will address that matter. If he is reluctant to give, then he is clearly non-complying with the auditing standards. And non-compliance with auditing standards leads to misconduct again. Not following the generally accepted procedures of audit, and SQC1 is a compulsory, mandatory for company audits. So you can't say I don't want to give, but at the same time I want to be compliant.
No, that non-compliance will surface only when some third-party review or something happens. Because see, all our friends who are proprietors are living in a past glory, thinking that I will not get caught. Since there is the history of my getting caught, the probability of myself getting caught is very low. So I need not bother now. That's the illusion which they are living now.
His
So
own
we
neighbor,
need to sensitize them.
His own neighbor or his own junior can make a complaint, or even a SEBI may take up, or even our FRRB can take up, or a quality review board is there. Anywhere this can get picked up. This particular balance sheet can be picked up by anybody, and then it can come from the institute side also.
Yes, sir, I fully agree with you, but the probability,
so members
looking at the previous years.
See, members are expected to note the requirements, comply with them, and stay away from getting caught. If you don't want to comply, then complaint is not far away from somebody or other. If not a complaint, there could be some information. See, there are informations picked up by various authorities and informed to the institute. SFIO has informed almost all cases to institute for a regular action. You see, in another case where compounding of offences, I have forgotten to cover the issue of compounding of offences by ROC. Many times you come across that the ROC picks up some balance sheets for review, and he finds some mistake or some non-compliance in the balance sheet, and he will first call the company people and say that these are the offences, you can come under compounding, so that I will charge some fee, and then you can get out of the compounding of offences. But along with the company, he will also call the auditor. And then he will make the auditor also to confess that there is a mistake and which I am accepting the compounding. And he will levy some 2,000 or 10,000 penalty, and he will apparently say that he is closing the matter. But there are cases where we have come across a case where, after assuring the auditor and the company of not taking any action with the institute, he went and filed a complaint against the auditor, saying a simple sentence that the auditor has confessed before me of having committed a mistake, and he has agreed for a compounding the offense. So that itself is a commitment of offense by the member. So therefore, many a times, even for a smaller offenses of the things, the ROC, etc., are taking a very stringent action on the auditors. So therefore, you cannot sit in a glass house and say that I am safe and nobody should throw a stone on me. So proprietor doing on record, I am talking. See, there are many firms where only a proprietor is sitting, but with a large number of partners, or at least more than 2-3 partners on record. At least on record, you should have some firm while doing the, even in peer review, you can't issue a clean certificate to such firms. And without a peer review certificate, he can't accept the audit of a listed company. So it's a chain process, so you can't escape. I do not know if there is any proprietary who is signing the balance sheet of a listed company, but definitely it is a very dangerous situation, and anybody can, even a peer reviewer can write that this man is not following and complying with the auditing standards in terms of SQC and other technical quality control review.
Okay, thank you for sensitizing this, which was very close to my heart in terms of making members aware of the consequences from now onwards.
No, not from now onwards. There are several members who are facing actions, and I have all sympathies for the. I'm telling you, I mean, there are still about 48 members on the Zoom. I can tell you, the moment you receive a notice from a disciplinary authority, you will get into such a bad moods and nervousness. Very few members don't care this, but 95% of the members will be in such a big tension and nervous till the case is closed. And it's a nightmare like a thing. I don't want any of our member knowingly or unknowingly to get caught under the disciplinary mechanism, because the moment you receive a notice, the clock starts. You have to reply, and he will have to face the music, and you have to read the schedule where you have committed the offense. You should have evidence to demonstrate that you are not at fault. The unfortunate thing is many of our members don't keep the working papers in a expected level. Many of the members might have seen the ILFS NAFRA report. One of the big four expected to be complying with the audit requirements in letter and spirit. The NAFRA put them in their first report in a very, very sad state of affairs. So many points, every point they said they are not complied, they have not complied. So it's really very sad to note all those things, but unless we really do a good work in bringing out the documentation and keeping it in your possession, it will be very difficult to face the disciplinary mechanism. And disciplinary mechanism can come from any quarter on anybody, and no exception for big or small or proprietors or partnership firms. And the members, whoever are signing, will be responsible. And another area, again, our institute permits on these numbers, the ceiling numbers are 45 or 60 audits. Even if there are two partners, 120 audits can be signed by one partner. And the partner who is signing will be responsible for all the work, for all the cases. He cannot say that I have signed the other partner's 60 cases. So people have to be careful while signing also, not to sign for others' work or other partners' work. That is, somewhere, at least unless you have a full confidence on the good work done by the other partner, you cannot simply take it for granted that my partner has done, so I will sign, and if something comes, you will only be accountable.
One more thing, can we share your presentation with the members, sir?
Why not? It is the property of Ethical Standards Board, and the standards are out now. But what I am doing, I am working out a new PPT solely covering the current the Code of Ethics. This talks more of a comparative thing between 2009 and 2019, and it is giving the new areas. So this doesn't talk exactly what is there in the total Code of Ethics. I am bringing out a new PPT, maybe another 10-15 days I may take. So once that comes, I will share that also. This you can very much share. It's already there.
Thank you, sir. Thank you.
I request Vijay, and then let's have one small session so that we can draft a template. Many members are asking, can we have a template so that it will be easy for us to comply? One
it takes
shot,
another 10 days.
That should be very good. We'll try to have one more small session.
We'll try.
Again, even a template also may not suit everybody, every client and every auditor also.
Yeah.
See, because there will be corporate, non-corporate audits, partnership firms or companies. Sometimes your relatives may be there, the directors there. So it's very difficult to create a template complying all the requirements. I mean, it's like a checklist. You need to refer to the concerned clause in the Code of Ethics or in Schedule 1 and 2. Schedule 1 and 2 are also covered in Volume 2. There are some commentary, case laws, all these advertisement guidelines, etc. are given. But still, let someone try to make it out. But I will try to prepare the PowerPoint and share it with you. So, I mean, you can share it with the members.
Yes, sir. You nailed the point that documentation is key, and we will sensitize the members in terms of what needs to be called as a documentation instead of just filing the reams and reams of client ledgers and all in their files. We will